Hello and welcome to a CMS Forex daily video recap. I'm your fundamental market analyst, Nick Nassad. Today is Thursday, June 17, 2010. Let's start with the euro-dollar pair, which had another day in which it rallied after yesterday's bit of consolidation. We moved above the 1.2350 area, which was the area of resistance for this week, and then used it as support later in the session, and we moved above 1.24 as well in today's session. We had an increase in risk appetite for the euro prior to the open of the New York session, as we had a reassuring bond auction in Spain, and as well as some other developments from the Eurozone banking sector. We had been looking at this upward sloping support trend line that was broken during part of today's trading, but following a test of 1.2241, we rallied yet again, moving above this resistance level as I mentioned. Spain managed to see some decent demand in its auction of 3.5 billion euros in 10 and 30-year bonds, but the sale did come in with some higher yields. The financial markets seized on the auction as good news, illustrating that the Spanish government has not been frozen out of the capital markets, and its yields, even with the recent rise, are well below what we had seen with Greece. Spain also said that it will publish bank stress tests, and those results will be published bank by bank, a move meant to calm fears as it should increase transparency around the Spanish banking sector. The Eurozone looks set to follow the Spanish lead and will publish the stress tests on a bank by bank basis for the 25 largest banks within the Eurozone. Now, we did see some consolidation, and the pair paired some of its earlier gains as we had a weak open in U.S. stocks after we had some weaker than expected manufacturing and jobs data from the U.S. That bout of risk aversion as a result of the U.S. data in the weak open in U.S. stocks was reflected rather sharply in the dollar-yen pair as we slid below our recent supports in this pair. We can see that we have been trading in this range for the last 8 or 9 sessions, and we broke below that in today's trading. We could also have an upward sloping level of support connecting our most recent lows, which was broken as well. Now, U.S. stocks did claw back a good amount of their losses, and we stopped this slide at the 90.50 level. The move in favor of risk aversion was also reflected in gold prices, which rallied strongly, and in the gold-dollar pair, we tested the 1,250.90 level. So we could see that traders moved into the quote-unquote safety of gold following the weak U.S. data. If we look at the pound yen, we see the dynamics of the risk sentiment rather clearly, as first we rallied prior to the New York Open, but then slid at the New York Open, though we found some support and rallied to the middle of where our range for today's session. Zooming this pair out somewhat, we see that the recent rally in risk, which is reflected by a rise in the pound against the yen, has stalled, as we have now a resistance level setting up at around the 135.90 level, and we broke our upward sloping line of support. The 200 period moving average in the 1 hour time frame did help to establish some support, and if we plot a Fibonacci retracement of our full up move, we could see that this also was around a 38.2% retracement, so a 1/3 move downward from this full rally. So we'll just have to see how risk sentiment progresses, if we see some sideways action, or if we're able to move above our recent resistance, extending the move in favor of risk appetite. If we switch over to the pound-dollar pair, we see that we had declined in late New York trading and in the Asian session, touching the 61.8% retracement of our move from Friday's low near 1.45 to our high yesterday. But unlike with the pound yen, where we slid a good amount in the New York Open, here we just consolidated at near the top of our range, and we end the session around above the 1.48 level. So there's still some bullish momentum, but so far it seems like our rally has paused and now is consolidating some of its more recent gains. Now let's see what set off the selling in U.S. stocks to open the New York trading session, and it was mainly weak jobs and manufacturing data. First, let's take a look at the jobless numbers, as weekly jobless claims rose by 12,000 to 472,000, a figure that was a one-month high and indicates that the recovery in the U.S. labor market will continue to be slow as firings stay elevated despite the growth in the U.S. economy. Today's data was especially disappointing as it missed forecasts of a decline in claims to 452,000. Following a downward trend in jobless claims throughout most of 2009, now claims have hovered in this 450 to 480,000 range in the past 5 months, with the 4-week moving average actually moving higher over the past few weeks. Economists see a move below 450,000 and even below 400,000 as an important step to actually seeing a labor market consistent with the declining unemployment rate. In the second report, that was a negative, we had the Philly Fed Manufacturing Index, which posted a reading of 8 in June from 21.4 in May, when forecasts called for it to post to 21.1. The Employment Index went into negative territory, the first time it had done so in 7 months, while new orders and shipments actually remained close to their previous month's levels. Also, prices took a pretty big dip both in prices paid and prices received. The Philadelphia Fed Index, similar to the Empire Manufacturing Index, is a leading indicator for manufacturing, and with U.S. economic data being uneven of late, and with considerable uncertainty regarding what the troubles in the Eurozone will mean for growth in the U.S., the report may be taking on more significance. We had a couple more releases in the U.S. Consumer prices for the month of May were down 0.2%, matching forecast, with the annual CPI at 2%. Core prices rose a very tame 0.14%. So this consumer inflation data joins the producer prices and import prices, showing that inflation does not pose a problem for the Fed, and it gives it leeway to keep rates at their record lows in order to stimulate the economy and help to buttress the labor market. And we also had a measure of leading indicators in the form of the conference board. We saw it actually rise 0.4% in May, which matched expectation. 5 of the 10 components measured contributed to the May increase, including the spread on the yield between 10-year treasuries and the Fed target rate for short-term interest rate loans to banks, as well as increases in money supply and longer factory work week. 5 of the components, including falling stock prices and building permits, contributed negatively to the index. So that was today's data, and overall what we get is that while the recovery is intact, the pace of expansion in the manufacturing sector may be cooling, and with the weak price pressures and the weak labor market, the Fed will continue to keep rates low. In another important fundamental event, the Swiss National Bank appeared to soften its tone in regard to the franc's appreciation. The SNB has been intervening heavily in the market of late, buying euros and selling francs in an effort to limit the appreciation of its currency. However, today the statement read that deflationary risk in Switzerland has largely disappeared, which is one of the main reasons they had been intervening in the market. The SNB gave an upbeat assessment of the country's economic outlook and upped its inflation forecasts. And only a return to falling prices exacerbated by a stronger franc would prompt the SNB to take action again, it hinted, giving a strong signal to traders that the currency is open to significant gain. The euro-franc pair responded by moving strongly in favor of the Swiss franc, retesting our lows that we had seen on June 9th, which was a record low for this pair. From high to low, that was about a 170 pip move. And we could see that this red candle, which corresponded to the SNB announcement, that was the bulk of the decline. Tonight, look for German producer price data and public sector net borrowing from the UK. And tomorrow, Canada posts its leading index as well as foreign security purchases. And that will conclude today's broadcast. For more news, videos, and analysis, please visit our site, cmsfx.com. I want to thank you for watching and wish you good trading.